In many parts of the world, construction is labor-intensive. In the Philippines, as late as 1975, laborers filled small buckets with concrete and swung them up to workers in order to build high-rise structures. Making gravel was done by workers using rocks to smash other rocks. We tend to think that as economies develop, these sorts of labor-intensive technologies of production will vanish, and that they'll be replaced by big machinery. A common belief is that this will happen once the economy can afford capital-intensive techniques of production. We'll find out in this segment that that belief is wrong. Decisions to choose labor or capital don't depend on the level of economic development, but on the prices of labor relative to capital. By seeking to maximize profits, firms choose the least costly methods of production. Today we're going to examine the relationship between production and cost. We'll discover how costs drive production decisions with a focus on the short run. Operating in competitive industries make decisions as to how much to produce and how to go about producing output. By deciding how to produce, firms are making decisions about demands for factors of production. Our emphasis in this episode is to go behind the firm's supply curve and show how costs of production drive the decisions that firms make. We'll be dealing with the short run. This is a period of time during which two conditions must hold. One, existing firms will be constrained by some fixed factor of production, and two, new firms can't enter the industry and existing firms can't exit. Recall, there are no hard rules to determine the period of time associated with the short run. It varies by industry. What we mean is that we don't have enough time to build a new factory, to launch a new communications satellite, or simply to get out of our lease for our space. In the short run, producers are faced with these sorts of limits on production. Many inputs are constrained over very long periods of time. This is especially the case in agriculture or mining. Production on a farm, for example, tends to be subject to the availability of land, and it may be very difficult for a farmer to acquire more. Now, although some factors of production are fixed in the short run, we'll assume there is at least one factor of production that's available in any quantity. The costs associated with the fixed factors are called fixed costs, and those associated with the variable factors of production are variable costs. Our new rule is that total costs are completely accounted for in terms of either fixed or variable costs. So we have the equation: total cost is equal to fixed costs plus variable cost.
So come with us to the newest and most modern of Detroit automobile factories. The plant just recently completed for the exclusive use of DeSoto. No longer ago than last summer, the 40-acre site of the most modern automobile plant was a peaceful grass-grown field. Almost overnight, the marvelous new DeSoto factory grew from a dream into magnificent reality. Glass and steel and concrete swung along in an orderly procession, reaching a climax on the proud day when the builders completed their impressive task, and the factory was turned over to the men who create DeSotos.
Examples of variable costs might include raw materials, labor, and energy. Fixed costs are usually associated with expenditures that reflect the size of the firm, such as structures and machinery. There are exceptions. For example, if a firm contracts for workers with a no layoff clause for a year, then labor would be treated as a fixed cost with a time horizon of 1 year. If the firm stopped production, it would still incur those labor costs. Now, whether we talk about fixed or variable costs, it's important to keep track of implicit versus explicit costs. Explicit costs are opportunity costs that take the form of explicit payments to suppliers of inputs that are used in production. They include workers' wages, managers' salaries, fees to lawyers and accountants, payments to the bank, and charges for materials used in production. As you can imagine, there are a lot of these sorts of costs, and they're kept track of by accountants. Well, there are other costs called implicit costs that accountants really don't see, but are nonetheless very important to the firm. They are defined as opportunity costs of using resources that don't specifically call for explicit payments. For example, if you begin your own business and don't take a salary, you're giving up what you could earn by working for someone else. That's an example of an implicit cost. If a firm uses a building that it owns, even though it doesn't make a rental payment to itself, it forgoes the income it could have received from someone else. Now, even though implicit costs don't appear in the firm's books, this doesn't mean they are less real than explicit costs. When we make the distinction between explicit and implicit costs, we then have two ways of thinking about profit. The difference between total revenue and explicit cost is called accounting profit. That's what appears in the firm's written accounts. It's defined as accounting profit is equal to total revenue minus explicit costs. Economic profit also takes into consideration implicit costs, so it's defined as economic profit is equal to accounting profit minus implicit costs. Well, generally then, economic profit is lower than accounting profit. A word of caution, though, is that costs are subjective, just as utility is considered subjective in consumer theory. The reason why is that opportunity costs reflect opinions about the best alternative use of resources. In a household, one person might think the best alternative use of $50,000 would be for a boat, while another might argue for certificates of deposit earning 8% interest.
Sunk costs are once-and-for-all expenditures that can never be recovered even if the firm exits the industry. When a firm opens a business and builds a sign, that's an example, since that sign would be useless to another company unless it had exactly the same name. Let's not confuse sunk costs with fixed costs. Fixed costs are ongoing costs of operations. Sunk costs aren't. We'll find that rational decision-making means that firms should ignore sunk costs, even though that might be psychologically difficult.
Let's look at some simple examples of cost functions in the short run. Our hypothetical example could be a very small brewery with fixed costs of $500. These fixed costs might include the rent on space and the opportunity costs to investors. In this table, we associate expenditures with quantities of beer. Quantity goes from 0 to 500 cases. Next, we show the quantity of labor that's used to produce the output. It runs from 0 to 120 hours. The variable cost column is derived from the labor column. We take the quantity of labor and multiply that by the cost of labor. Next, we add fixed costs. They're constant at $500 at all levels of production. The total cost column sums variable and fixed costs. Now, what's driving the cost behavior is the production function. Well, let's take a look at each and how they relate. We start with the production function. Then multiply the magnitude on the horizontal axis and then rotate it 90 degrees to arrive at the total variable cost curve. Then we shift this up by our fixed costs to arrive at the total cost curve. The data show us regions of high and low marginal productivity of labor. With diminishing marginal productivity, we require more and more workers to produce a given amount of output. So the flattening of the slope of the production function is associated with the increasing slope of the variable cost curve. If marginal productivity remained constant, then the variable cost curve would be linear, at least in competitive input markets. What would happen in non-competitive markets is that the firm might drive up the price of labor as it demanded more and more hours of work. The relationship between diminishing marginal productivity and the elevated slope of the variable cost curve is best understood in terms of marginal cost. Marginal cost is the added cost associated with an additional unit of output. Algebraically, it's defined as marginal cost is equal to the change in total cost divided by the change in quantity. Notice that marginal cost measures the slope of the total cost curve. From the example above, we see that as output increases, the slope of the line tangent to the total cost curve increases. Well, why is that? Well, remember, as output increases, the firm experiences diminishing marginal productivity.
And now it's time for Chalk Talk with your host, Miss Sarah.
Now we're going to talk about total costs, marginal costs, and average cost. In the short run, a firm has a group of costs called fixed costs that it incurs regardless of the quantity that they produce. Fixed costs might be somewhere here. After this point, costs increase as quantity increases. Marginal cost is the change in total cost divided by the change in quantity. So the marginal cost turns out to be the slope of the total cost curve. And the marginal cost will change at different points. The additional costs incurred by an additional unit of output, that's the marginal cost. Average costs are equal to total cost divided by quantity. The average cost on this graph is the ray from the origin to any point on the total cost curve. So it's total cost divided by quantity.
We can derive marginal cost from output data as follows. In this table, we've just duplicated quantity and total cost. Quantity runs from 0 to 500 cases. Total cost goes from $500 to $12,500. The marginal cost column is computed by computing the change in total cost divided by the change in quantity. For example, when quantity changes from 0 to 100, total cost changes from 500 to 1,500. Marginal cost is thus 1,500 minus 500, or 1,000, divided by 100 minus 0, and that result is 10. We continue this exercise and complete the rest of the table, taking the differences between total cost and dividing them by the differences in output.
Now that we have a clearer idea of how much it costs per case, we should be able to figure out whether or not it's profitable to make beer. By this we mean that if beer sells for $12 a case and our firm's costs are just $10, it makes sense to produce at that level. A very important rule then is for the firm to compare the marginal benefit from producing one more unit of output with its marginal cost. And in fact, that's the equilibrium principle for all firms. We produce up to the point where marginal revenue, or what we gain from selling one more case, is equal to the marginal cost. One of the assumptions of perfect competition is that all firms are price takers. What that means is that a firm can sell all it wants at the given market price. So let's say the price is $10 a case. If we sell one, our revenue, which is price times quantity, is 10. For two, revenues are 20, and so on. Now, marginal revenue is calculated as the change in total revenue divided by the change in quantity.
In this table, we look at quantity from 0 to 3. The price is $10, and total revenue is derived by multiplying price times quantity. So it ranges from 0 to 30, which is 10 times 3. Marginal revenue is computed by taking the difference between total revenue and dividing by quantity. It's constant in this example at 10. Finally, we compute average revenue, which is total revenue divided by quantity. In this table, it's also constant at 10.
We've looked at the firm's revenue side, including total revenue, average revenue, and marginal revenue. Now let's compute profit, the difference between total revenue and total cost.
To keep things simple, we'll stay with our beer example and assume a price of $12 a case. And since our firm is in a competitive industry, it takes that price as given, so it can sell all it wants at that price. Well, here are the basic data. In the first column, we see the quantity produced, which goes from 0 to 500. From our previous example, the next column shows us the total cost at each level of production. So column 2 goes from $500, which is our fixed cost, to $12,500 when output is 500. Again, we also see the marginal cost column, which is the change in total cost column divided by the change in quantity. Of course, when quantity is 0, marginal cost isn't defined. Next, we see the price column, $12. It's constant because the firm can sell all it wants at the market price. Total revenue is simply price times quantity, so it sweeps from 0 to 6,000. Marginal revenue duplicates the price column. It's defined as the change in total revenue divided by the change in quantity. And finally, in the last column, we see profit. It's the difference between total revenue and total cost. It goes from minus $500 to minus $300 and up to minus $6,500. Using this data, let's compute total revenue, and that's done by multiplying price times quantity. So, when we sell 200 cases at $12 per case, our revenues are $2,400. Recall that our firm's objective is not to maximize revenues, but to maximize profits. And that's the difference between total revenue and total cost. Well, but look at this. Profits are always negative. Well, how can this be? Did we make a mistake? Well, first notice, though, that although we're losing money, our optimal production level is at 200 cases, and that just loses us $300. So if we don't produce anything, we lose $500, and that represents our fixed costs. By producing, we actually cut our losses by $200. That's because our net operating revenue is positive at that production level. Recall that the net operating revenue is the difference between total revenue and total variable cost. In this table, we duplicate the information from our previous examples. Quantity goes from 0 to 500, revenues from 0 to 6,000, and variable costs from 0 to 12,000. The difference between the second and third columns is net operating revenue, and that jumps from 0 to 200 and then drops down to a minus 6,000. In the short run, as long as we can find a production level where net operating revenue is positive, it pays for our firm to continue to produce. You see, there's no assurance that when we open a business we'll earn a profit. And remember that all of the numbers we've been looking at include both explicit and implicit costs. So our profit, which in our case is a loss, represents a true economic loss, and we may well have an accounting profit. For example, in computing our fixed cost of $500, we included implicit costs such as payments to investors. Let's say that the major portion of this, maybe $300, comes from the owner's contribution to the firm, and that she or he obtains a tremendous joy in making beer. Now, although she may be able to earn $300 elsewhere, the subjective value of the next best alternative to making beer is nowhere near what we've computed it as. In other words, we might have made a mistake in imputing $300 in lost wages our entrepreneur could have earned. So decision makers have to be very sensitive to how implicit costs are calculated. Let's generalize what we've learned and derive a geometric model to help us predict firm behavior. We begin by graphing total revenue and total cost. They go on the vertical axis and quantity on the horizontal axis. The total revenue function is easy. Since total revenue is simply price times quantity, it plots as a straight line from the origin with slope equal to the price. Remember that total cost in the short run is made up of fixed cost and variable cost. Fixed cost doesn't depend on Q, so the fixed cost function plots as a horizontal line at fixed cost. Next, we consider variable cost. Variable cost is typically a complicated function that slopes upward. Because of diminishing marginal productivity, it eventually has a very steep slope at higher levels of output, as we can see here. Profit is the difference between total revenue and total cost. In this diagram, it starts out negative and we hit a break-even point at point A. For this example, profit is then positive until point B, when we hit our second break-even point, where total revenue equals total cost. From this point on, profit is negative. Next, we can plot the average and marginal functions. The average revenue and marginal revenue functions for firms in perfect competition plot as horizontal lines equal to the price. The firm takes the horizontal line as its demand curve, which is labeled as average revenue, or AR. Average cost is total cost divided by quantity. A simple geometric relationship is that the slope of a ray from the origin to the total cost curve is average cost. We begin with a graph of the total cost curve. The dimension of the vertical axis is in dollars, and quantity is plotted on the horizontal axis. Average cost is then shown. On the vertical axis, the dimension is in dollars per unit of output, dollars divided by Q. And on the horizontal axis, we plot quantity. The height of the average cost curve is the slope of a line from the origin to the total cost curve. Because of the more complicated nature of the total cost curve, the slope falls, reaches a minimum at point A, and then rises again. Whereas the slope of a ray from the origin is average cost, the slope of a line tangent to the total cost curve is marginal cost. The graph reveals that average cost follows marginal cost, but doesn't react as quickly. Average cost will decline if marginal cost is below the average, and will increase if the margin is above the average. Well, imagine your GPA is representing average cost. If this quarter's grades are above your overall average, your GPA will increase, but regrettably not by as much as your new higher grade point average. On the other hand, if you bomb this quarter, your GPA will fall, but happily by not quite so much. The goal of the firm is to choose a level of production to maximize profit, and that we see indicated here. We have an analytic rule that says produce until marginal revenue equals marginal cost. Let's play with this model a bit. Let's see what happens, for example, when prices change. Let's say there's a drop in demand for the product that our firm produces. That leads to a decline in the market price, as shown in the diagram. From the firm's perspective, marginal revenue falls. With declining product, the firm reacts by cutting output and moving along the marginal cost curve. So that's the firm's short-run supply curve. If product prices increase, then just the reverse happens. A typical firm will increase output when prices rise. We see it here. Let's begin with an increase in demand shown as a shift to the right of the industry demand curve. As prices go up, the firm's marginal revenue curve rises. The firm still wants to choose output where marginal revenue equals marginal cost, so output increases along the short-run supply curve. If product prices increase, then just the reverse happens. A typical firm will increase output when prices rise. As prices go up, the firm's marginal revenue curve rises. The firm still wants to choose output where marginal revenue equals marginal cost, so output increases along the short-run supply curve. In the first example, with declining prices, the firm might find that its economic profits are negative, and in the second example, that economic profits are positive when prices are higher. In the long run, we'd expect firms to exit the industry when profits decline and firms to enter when profits are large. And that's just what happens. We'll explore long-run decision-making next, so stay awake.